Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your agriculture update for this Monday, the 4th of February, 2019, around 2:40 p.m. Central Standard Time. Grain markets steady but holding. And remember, we get the State of the Union tomorrow. The president may spring something. You never quite know what's going to happen in these type of speeches. As we grind down, I'm sure one of the things you're aware of if you watch Sunday morning TV, as I do in all the different press shows, the Congress is saying that they have to have a plan, whatever it's going to be, by this Friday, not the 15th, because you got to print it out, you got to send it on to the members, they have to read it, they have to decide do they like it, there's going to be all the caucus talking and so on. It's not the 15th. It's actually this coming Friday. We'll see what the president does. Is he going to invoke a national emergency on the border wall? What's going to happen with trade with China? These are all big items. You had some short covering in the hogs, up about 5% today. So it gives you an idea. You're at that time where you've got to pay attention to trade. And of course, we're just coming off that horrendous weather that we all had. In Chicago, we were 50 over the weekend. It's hard to believe we were minus 26 just days before. No wind chills. When you look at the weekly area chart of closes, beans have still climbed up very, very nicely on the daily charts. You can see that they spike high into the 930s. We backed a little bit off from. And the chart's a funny one. This is an outside day down. If you take out the high of an outside day down within 2 trading sessions, and this admittedly is my own rule, I call that a bear trap. And then I look to see, is there another number over the market that might make sense that the market captures these people and goes to. As you can see, the market had one day of a rally. Now, if it takes out that low tomorrow, this was just a blip on it. The problem is, no matter how I want to look at the swing line, I've got higher lows until this low takes that out. What is the right pattern? The swing line, as I built it, still will maintain that you've got higher lows, higher highs. But I have another term for this, and I've used it since I built the indicator. I call that an ugly chart that needs resolution. When you have that outside day down, and notice it fell back right to that line in the sand, as I call it, the 18-day moving average of closes, which is the number that I think on a chart is where support comes in. A market decides from that number what the next event is. While you rallied away from it, you're now falling, and I wouldn't be surprised if tomorrow if you slip again down there. Wouldn't surprise me. But again, I'm having trouble with the chart. I have upside bias. The market, when you came out of this ugly day, I look for the closest of, I have a couple of other tools like window envelopes and the like, but the most popular is a moving average that I use or a Bollinger Band. That's where I would think the market would run into the resistance. Boom. You went right to the top there, slipped back. I think the pros came out. I think they caught a group of people right here. There was no follow through to the market either. And staying over an upper Bollinger Band, it's not an easy task. You can do it, but it only occurs 5% of the time or under it. That doesn't mean you don't bend these lines. The problem is the lower Bollinger Band and the upper Bollinger Band are really far apart. So they didn't narrow into a zone where it's like in a pipe and you're spinning for price. You have something else. You're correcting an overbought condition. The bias is up, and I can't determine what the real swing line is. When I come to the meal market, you had here the outside day up. Now, let me explain the difference in this case. If you'll recall, I said that one of the things I look for is to go back to a key moving average. All it owes, if this is taken out, is the 18-day average of closes. That's it. You spun up there, and you pulled right back to it. It hit it and did it. It's the closest of a moving average or a Bollinger Band. I teach all this in my charting course, and you have to review that in order to learn the technique, but it's very, very set in stone. So I can see what the market's doing, but again, I don't see a trend that's working there. Now, I got another problem in the soybean oil market. You've lost the embedded reading with today's action. So now, well, you did intraday. You've kept it by the end. Let me show you what I mean. On Friday, the market had a big outside day down. As you can see, the slow stochastic was pointing lower. Intraday today, when the market was down sharply, it had lost its reading. It gained it back by the close. This means that the market's out of a trend. Innately, what's happening is the market is starting to weaken on this. That's when you start losing intraday and getting it back and forth. But that's all that you can say. There's no reason, as I see it on the chart, to be bearish. You still have upside bias as you're over the 18-day average. You still have the embedded reading. But I see that problem when you start losing that number. In the corn market, how long do you want to fight at what I call that line in the sand, the 18-day average of closes? I think you'd agree. It's just almost every day we're on either side of that number. From here, trends develop. Just keep that in the back of your mind. This is how you start spinning the market and forcing these Bollinger Bands to stay fairly narrow, and you eventually break out one way or the other. In the wheat market, we've come up, but this is not the ideal time of the year where wheat rallies. You ended a bear trend. What do I mean by that? If we look at this, we had a pattern of lower highs, lower lows. The market made a run for the lower Bollinger Band. Within 2 days, came back at the 18-day average of closes, and this was last Thursday, not far away. You then had that monster rally on Friday, tried to follow through, up a little bit today, penny and a half. So you're here, but you're caught between the 100-day average and the upper Bollinger Band. In addition, you have a lower low, higher high, and now what are you doing in momentum? You're in overbought territory. There's got to be better charts than that. Sugar could be a surprise. Sugar today set itself up with an outside day, took out Friday's lows and highs, closed higher, closed over the 18-day average of closes. If you take out today's low on Tuesday or Wednesday, then I'd look for the lower Bollinger Band. Barring that taken out, does the market have enough oomph in it, and that's going to be the question, to get up to the upper Bollinger Band? It's certainly developing this sideways action that I look for. The swing line is up. Momentum is trying to turn up, and bias is up. It's out of its bearishness. In the coffee market, you are still caught in this. This is what I talk about when I say you're getting to a pipe and the market tries to figure out what to do. Tell me the number the markets keep fighting at. There's two numbers right in front of you that are happening. Your 18-day average of closes, the line in the sand in red, and the upper Bollinger Band. So you keep trying to break out, you keep getting thrown back, you're coming back to this number. My guess is the pros are picking it up there, but I can't call it a trend. I call this a trading affair market more than anything I do. I've got the swing line with lower highs and lower lows. The market's over the 18-day average, and the bias, well, actually the momentum is trying to turn up. I don't know what to do with it. In the cocoa market, you got down to the lower Bollinger Band. You fought a battle at the 100-day average back here. Got down to that number, actually did it 3 days ago. If you rally, what was a support zone becomes resistance. I see two levels, right here, the 100-day and the 18. Momentum is locked in, it's bearish. Market comes up, you can see how now the momentum's picked up on you here. Did you lose the embedded reading? Not yet, you still kept it. So if you lose the embedded reading, then I'm going to look for the 18-day average of closes. However, until it's lost, it's still bearish. This is the zone that the market's got to determine what it wants to do with next. In the cotton, similar to what we saw in coffee, do you see the sideways action that's developing? And again, on breaks, it's trying to find support at this 18-day average of closes. When it was under it, it got up to it, fought a battle there, made one run to the upper Bollinger Band, hasn't been able to go anywhere or hold really a trend. What you have is negative bias because you closed under the 18-day average. Momentum is pointing down, and you don't have a trend. You have a higher high, lower low. In the cattle market, a nice bounce, but I don't know what's weather related. You know, last week was so unusual in, what, 2/3 of the United States and cold, and there were many areas in the Midwest. You couldn't move cattle in the feedlots. You were just trying to keep your animal, keeping his weight on. That's how cold it was. I was hearing farmers couldn't even go out. Lower low, higher high, sideways action. That's where I'll leave it, in a sideways market. Same thing in the feeder cattle. It's like every day you're hitting now that 18-day average. You try a breakout to the upside, it fails. You try a breakout to the down, it fails. It's looking for direction. And in the hogs, this could be an important day. This is a huge jump in price. You finished up on the day 4.86%. It's the first big rally. Now, the last rally high is what we have to see. If you can take this out in between current prices, the next resistance is up here, but there's something else. If we take a look, you had an embedded reading. You lost it on the close today. When you lose it, that often leads to price and the 18-day average coming together. That's what I'm looking for. When we start talking at this time of the year about grains especially, one of the things you want to get your hands on are what are the seasonals for this time of year. And more research does a really good job of tracking what markets have done. Now there's a caveat, and you've got to remember that. Past performance is no guarantee of future performance. We look at it though. We want to know, what's the farmer doing? What's the time of the year for the cash markets? What about the meats? Do they do something special as we start leaving winter, getting closer to spring? Things of that nature. And what they do is they keep going forward. So their March trades have just been released, and they give you an idea of the probability in different markets. In order for a trade to be listed by them, I think it has to have won 13 out of the past 15 years. There'll be an exact entry and exit date. It is not meant to be followed by itself. You should use this with other filters. I can't make it any clearer. But is it something to look at? If it wasn't, I wouldn't be presenting it. I think seasonal trades are and continue to be important. And it does spreads as well. So if you'd like 2-week free access to it through us, they've made it available. Just go to our website. You'll see our free offerings. It'll be in there. You will be able to look at the seasonal patterns. You'll be able to play with them. They write special reports that you'll be able to get. Quite a service, and I've probably been with them 35 years, so it gives you an idea. I'm guessing, but it's got to be decades that I've been with them. How do you get this? Give them a call. By the way, when I say I'm with them, I buy their service. They don't give it to me for free. 2-week trial free. Call us. Go to our website. You can sign up that way. I'm Ira Epstein.